In this video, we're diving into one of the most advanced and essential concepts in smart money trading, inducements. Inducement zones play a critical role in how institutions manipulate liquidity and influence trader behavior. Yet they remain one of the most misunderstood elements of market structure. These areas are deliberately created to build false confidence, drawing traders into setups that appear high probability but are ultimately engineered to fail. By learning how to identify true inducements, you will be able to filter out deceptive price action, recognize valid order blocks, and avoid the liquidity traps that consistently capture most retail traders. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. To begin, let us first explore the fundamentals of price behavior from a market structure perspective. Price action is built on three primary types of movement: impulse, corrective, and continuation. Each of these movements is formed through internal candlestick structures. Now let us take a closer look at each component in detail. Impulse movements represent strong directional moves that align with the prevailing trend. Within an impulse phase, price moves with strength and conviction, often creating clear bullish or bearish trends. This stage is typically driven by strong market sentiment, where either buyers or sellers are clearly in control. For instance, if we look at a bullish sequence of candles, we can observe that price forms a series of smaller candlestick-based impulse and corrective movements that collectively push price higher until a swing high is reached. From a structural perspective, it is important to interpret these internal bullish formations as a single unified bullish impulse leg. The reason for this is that price has not yet taken out or meaningfully swept the liquidity resting below any of the previous minor internal lows. Even so, when viewed at the candlestick level, this movement is classified as an impulse. Following this, we observe a valid pullback, where price breaks and closes below the most recent bullish candle, forming a bearish candle that represents a minor correction. After that, another impulsive movement appears, which we define as a minor continuation. As we can see, price continues to follow this pattern repeatedly until it reaches the swing high, and in this example, forms a deeper corrective phase. With that established, we can now shift our focus to corrective movement. A corrective move is essentially a temporary counter-trend phase that moves against the primary direction of price. Therefore, within a bullish market structure, a correction is confirmed when price breaks below an internal pullback or internal low, or when it sweeps the liquidity associated with that level through a wick. In this scenario, the correction is represented by a sequence of three bearish candles, showing the price has moved lower and taken the liquidity below the most recent pullback low. Shortly after, price resumes its upward movement and eventually breaks above the most recent swing high. This progression leads us to classify the move as a continuation. In a similar example, within the second candle sequence, we again observe price forming a series of smaller internal impulse and corrective movements pushing upward until it reaches a brief pause and then retraces lower through another set of three bearish candles. Since price has not broken the lowest point of any internal pullback or internal low, nor retraced to at least the 0.382 Fibonacci level, which is an important rule within the ComLucro framework, and has also failed to sweep the liquidity below these levels in this sequence, we cannot classify this as a valid corrective movement. Therefore, this price action should be interpreted as a single impulsive move without any correction. These concepts also apply to bearish market conditions. It is important to understand that these principles are valid across different time frames and can be applied to any price action-based chart. Make sure to watch the video carefully until the end, as in the second section, we will explore different types of inducement and the price behavior associated with them that you may encounter in real market conditions. Moving forward, let us now shift to the next topic and focus on how to identify a valid inducement using candlestick patterns. In this part, we will go through the key criteria and rules that must be followed for proper analysis. In a bullish scenario, a candlestick-based inducement occurs when price breaks below or effectively sweeps the liquidity of the lowest point of a bearish candle, which represents the most recent valid pullback. For example, in the illustration provided, we can see that price forms successive minor internal impulse and corrective movements before entering a retracement phase, followed by a temporary downward move formed by 3 bearish candles. Price then breaks and closes below the most recent internal pullback, signaling a valid inducement and confirming the previous high as the valid major high. In contrast, within a bearish scenario, a valid inducement forms when price breaks above or sweeps the liquidity above the most recent internal pullback, confirming a new major low and already establishing a new break of structure. If price then breaks and closes below the newly confirmed major low, it is important to understand that for an inducement to be fully confirmed, price must break and close above or below the most recent major high or major low, forming a valid break of structure. Looking at the bullish example, we can observe that price breaks and closes above the most recent major high, confirming both a valid inducement and a valid break of structure. At this stage, we have clearly identified a valid break of structure. Now, following this break, the next question is where the potential inducement area is located. We can observe that price formed an internal pullback before breaking and closing above the most recent major high. In this case, the lowest point of that bearish candle becomes the inducement level, and we expect price to retrace back, sweep the liquidity below it, and confirm this high as the new major high. After mitigating the extreme demand zone, price is expected to reverse and continue moving upward, creating another break of structure by breaking and closing above the most recent higher high. Before we move to the next topic, it is essential to highlight some key considerations when identifying candlestick-based inducement on your chart. To confirm a valid inducement, as discussed earlier, price must take out the lowest point of the bearish candle, which represents the most recent valid internal pullback. This can occur either through a candle body closing below the level, or through a wick that sweeps the liquidity beneath the candle and then retraces back within the range of the lowest point of the most recent pullback, as shown in diagrams 1 and 2. On the other hand, as illustrated in the third diagram, price fails to break below the lowest point of the latest internal pullback, whether by a body close or by effectively sweeping the liquidity with a wick. As a result, we cannot classify this as a valid inducement. Instead, it represents a continuation of a single impulsive movement. Now, let us explore why inducement is so important within a trading strategy and why identifying and marking these areas on the chart is essential. To better understand this, consider a bullish structure that reflects typical price behavior. In this scenario, price is clearly in an uptrend, forming a sequence of minor internal impulse and corrective movements before entering a retracement phase, where we observe a temporary pullback formed by 3 bearish candles. In this case, price moves below the most recent internal pullback, signaling an inducement and confirming the formation of a major high. As selling pressure begins to fade and bullish momentum starts to build again, price is likely to continue in the direction of the prevailing trend. Moving ahead, we can see that price attempts to push higher, but is unable to break the previous higher high. Instead, it forms an internal high, followed by a minor pullback to the downside, represented by a bearish candle. With increasing bullish strength, price then delivers a strong, impulsive move upward, breaking the previous structural resistance and establishing a new swing high. At this point, we have a clear break of structure to the upside, along with a demand zone formed at the extreme of that move, which holds the potential to act as a reversal area. However, it is important to recognize that there is also another nearby zone that remains unmitigated, which can create uncertainty for traders when deciding which zone to engage with. There are, however, several important points that must be taken into account. As explained earlier, the upper order block functions as an inducement zone because it represents the most recent pullback formed prior to the break of structure, and we consistently expect price to trade below it. For this reason, that zone should not be considered a valid trading opportunity. Another key aspect is that for a break of structure to be valid, price must first form an inducement. If no inducement is present, then we do not have a valid break of structure, and as a result, no valid order block to trade from in this context. Since the upper order block acts as an inducement, it should not be treated as a valid demand zone, as price is expected to sweep through it. The extreme order block, on the other hand, is only considered valid and safe for trading once a confirmed break of structure is established. To reach that confirmation, price must create an inducement by taking out the upper order block. Only after this occurs can we consider the extreme order block as a valid point of interest for entering the market with a long position. With that in mind, let us now move on to a real chart example and combine all the concepts we have discussed. In this part of the video, we will focus on how to properly identify valid inducements in live market conditions. In this example, we are analyzing the euro-dollar on the 15-minute time frame. As observed, the overall market momentum is bearish. In this situation, price forms a sequence of internal bearish impulses and pullbacks before entering a temporary pause and beginning to move upward. We can see price pushing higher, taking out the most recent pullback and signaling a valid inducement. With this valid inducement now formed, we can confirm the presence of a major low. In addition, we now have a valid break of structure, since price has broken and closed below that major low. And this recent break confirms the corresponding lower high as the most recent major high. The next step is to identify the upcoming potential inducement zone associated with the latest impulsive movement. As mentioned earlier, a candlestick-based inducement occurs when price breaks below or effectively sweeps the liquidity at the lowest point of a bearish candle, which represents the most recent valid pullback. The next step is to identify the most recent internal pullback within the impulsive move that led to the latest break of structure. As shown, this candle marks that internal pullback. From this point, we expect price to move higher, take out the high of that candle, form an inducement, and then continue in the direction of the bearish momentum. Now let us observe what happens next. As we can see, price moved upward, but failed to break above the high of the most recent internal structure, meaning no inducement was formed, and price is now attempting to move lower. For that reason, this lower low is not yet confirmed, and we cannot classify it as a valid major low. Let us continue and analyze how price develops from here. At this stage, price pushes further to the downside, breaking and closing below this structure. However, this move cannot be considered a valid break of structure because price did not form a valid inducement beforehand, and this level itself does not qualify as a valid major low. As a result, this break cannot be validated, and the entire move should be treated as a single impulsive movement. It is important to remember that for a retracement to be valid, price must either break the lowest point of an internal pullback or internal low, or retrace at least to the 0.382 Fibonacci level, which is a key rule within the ComLucro framework, and it must also sweep liquidity. If these conditions are not met, then the price action should be interpreted as a single impulsive move without a correction. Now we can observe that price has formed internal pullbacks within the most recent bearish impulse. As indicated by this candle, it represents the latest internal pullback. Based on this, we expect price to move higher, break above the high of that candle, create an inducement, and then continue with the prevailing bearish momentum. In this situation, our strategy is to remain patient and wait for price to move higher, break above the most recent internal pullback, sweep the liquidity at that level to form an inducement, validate this lower low as the new major low, and then confirm a valid break of structure. We view this zone as having a high probability of causing a reversal as price returns to it, since it is positioned above the 50% level within the premium zone. It is also essential to remember that without a valid break of structure, a valid order block cannot be identified. The next step is to wait for price to retrace upward and tap into the supply zone we have marked. Now, let us observe what happens next. As shown, price moved higher, swept the liquidity above the most recent internal pullback, formed a valid inducement, and after mitigating the supply zone, located at the extreme, price reversed and continued downward with stronger bearish momentum, ultimately creating a new break of structure. To wrap up, mastering inducement allows you to move beyond surface-level price action and truly understand how liquidity drives the market. By combining market structure, confirmed breaks of structure, and precise inducement identification, you gain the ability to filter out deceptive moves, focus only on high-probability zones, and align your trades with institutional intent. This is what shifts your trading from random execution to a structured, disciplined, and consistently repeatable approach in real market conditions. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.